So my name is Todd Roselle. I'm a certified financial planner with Blue Rock Financial Group. And we receive a lot of questions on the basics, and we receive a lot of questions on the complicated. And what I want to do today is take a step back and go through three basic items that are really somewhat of the foundation of someone's financial situation. Budgeting for number one, stocks, aka investing, and also bonds, which could equate to investing as well as holding cash, which we'll talk about too. So when we think about budgeting, a lot of people view budgeting as a dirty word. And ultimately, we all have fixed expenses and we have variable expenses. And where we tend to overspend, or I should say, not know where our money goes, is in those variable expenses. And a good frame to think about what you spend is that anything that's in your checking account is there to be spent. So try to figure out what you need to spend every single month, good month or bad month, groceries, cell phone bill, things that you're going to do on a regular basis, and that money is sort of your basis for what you need to spend. Everything else is gravy and can be used to cover your variable expenses. But one way to have budgeting work for you, as opposed to have it run you, is to actually reverse budget. So create a line item for savings so that you actually know what you're going to save every month, good month or bad month, and that is a line item within your expenses where you're paying yourself. We'll talk more about this in a minute, but then we need to determine where that money will go. Will it go to a cash account? Will it go to an investment account or something else? But with the reverse budgeting concept, good month or bad month, we're saving money. Now, we all know as well that there's seasonality to our spending. We typically spend a little bit more in December for the holidays than we do in, say, January. So with that, think about the seasonality of your spending. When you have the ability to save more month by month, it takes discipline to move that money out of your checking account as opposed to going and buying something, new clothes, buying a new car, whatever it might be. It takes discipline to move that money from that checking account to a savings account over and above your stated amount of savings. So when we save, we start to think about where are we going to save money. And if we are going to be making future purchases, that money should remain in either a savings account or a money market account because it would not be subject to market fluctuations. If we're thinking about buying a second home, a second car, whatever the case may be, and we know we're not going to make those purchases until about a 3 or beyond year time frame, then it's really good to put that money to work for you. Put it into an investment. The investment could be stocks and bonds, which we'll talk about shortly. It could be exchange traded funds. It could be mutual funds. It could be a variety of investments, but something that's going to command a higher rate of return over that 3+ year time frame than, say, cash. We also need to think about retirement. So, when you start to think about retirement, we're thinking about that 59 and a half time frame and beyond. Doesn't mean you have to wait till 59 and a half to retire, but that is when we can touch our retirement assets. So those monies will be going aside really for all of your life to be able to support your lifestyle later when you no longer have an income. Financial freedom is really what we call that now. We don't call it retirement because retirement was a term that was used long ago, and many people these days continue to work in some capacity even after they stop doing what they do day to day. Now, when we think about how much should go into different accounts and what the impacts of those accounts are, if we're putting money into a cash account, a savings account, a money market account, something of that sort, we have to understand what the cost of that money is. And what I mean by that is if you're earning 5% on your cash that's sitting there for a future purchase, understand that you are going to have to claim the interest that you're earning on those accounts on your taxes. That interest is going to be taxed just as though you earned income in that given year, which is typically your highest tax rate. So if you're getting a 5% rate of return on your cash and you earn a substantial amount of money, understand that that tax rate on that money sitting there is going to be very expensive. So where you earn 5, you may only keep 2.75% of that. So does it make sense for you to put a substantial amount in cash that's not going to be spent? Probably not. It should be spent in a short period of time. If we think beyond that 3-year time frame like we were talking about before, this is where you can invest in stocks or bonds, exchange traded funds, real estate, things that are beyond cash and that you may need time before you receive those assets. Time will be your friend when you're investing for a longer period of time, which then means that you will allow those assets, in most cases, to return a higher rate of return than you would receive in just a simple cash account. When we think about retirement and saving for retirement, a lot of times those vehicles are offered at our place of employment. It could be a 401k, a simple IRA, a 403b, if you're a government employee, a TSP. But these are all accounts that are employer sponsored and allow us to put money into them to then take out much later in life. Many times our employers will have some sort of incentive or match that will put dollars in on our behalf as well. With that being said, these are typically your most aggressive accounts, meaning that you know you have time before you're going to touch them, hopefully 20, 30, 40 years, and you can afford volatility in those asset classes. Again, we'll talk more about that soon. But nonetheless, when you think about savings, when you think about budgeting, when you think about spending, think of it in these terms. Checking account is for money coming in and going out each and every month for your fixed and variable expenses, understanding that there is seasonality to our spending. When you look beyond those cash accounts, we start to save for future projects or future things, okay? Those future things could be actual purchases, they could be supplemental retirement dollars. But again, when we look beyond cash, we want to put our money to work in such things as a brokerage account or real estate or something that's going to receive a higher rate of return. Also, keep in mind, the assets that you put in that investment area, such as brokerage or real estate, will likely receive favorable capital gain treatment upon sale, as opposed to income tax treatment like your cash account will. So when we think about budgeting, we not only want to think about what we're spending today, we want to think about what we're saving today, we also want to think about what we're saving for tomorrow, and then of course, what we're saving for the financial freedom phase of life.